Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So FX as an asset class. Prior to globalization, many investors kept their money in their local equity and bond markets for safety reasons. The new modern portfolio theory states that rational investors should seek undervalued assets with low correlations that help smooth out investment results. So the portfolio approach, what it suggests is that investors might want to add low correlated instruments to their portfolio to smooth out your results. An investor might want to choose some of their familiar equity option strategies in the FX market since the correlation to the equity market is somewhat low. Why this makes sense? Well, whether you like to trade with a directional bias or trade with more of a volatility bias, FX options can possibly smooth out your trading results. You're going to need to actively manage your trades. Just remember, though, managing assets that aren't all moving in the same direction is much easier than, let's say, and if you take it to, let me use an equity metaphor. If you were long all airline stocks or all oil stocks, that would be great if you were right, oil or airline, but terrible when you're wrong. So your portfolio could be down a tremendous amount if you're just long all oil or all airline, so you're probably going to want to balance the two. So positive correlation, that just means, let's say, what's the price of crude doing? Well, positive correlation, many oil stocks would move in the price of crude. Negative correlation would be the opposite. What's crude doing, and how does that affect an airline? You know, and if they don't hedge, more than likely they're going to have an inverse relationship. Some relationships that you won't see any. There's no relationship between X and Y. High correlation. So in the real world, you're not going to see a linear situation. You're going to see, let me see if I can draw this here. Really what you're going to see is a linear regression that's going to sort of be somewhere like that. It's not going to be perfect. You're going to sort of have this kind of trend. Equity volatility tends to be higher than currency volatility. So we know that currency volatility should be much lower than equity. Rolling 5-year correlation of equity and currency markets. What's interesting to see is that this is interesting. You'll see the blue line here is the Australian volatility, and that's going to make sense. The idea that since the Australian economy is so based on commodities, when the rest of the world is doing well based on low inflation, that's probably not good for Australia. But when we're at the end of the cycle and inflation starts to heat up, that means it's very good for Australia. So AUX is going to trade a little bit differently. CDD is also going to be somewhat similar to AUX, a commodity-based currency. So let me give you some examples. This is January 5th, 09, just the other day. So we could look, and if we're trading at 119, the at-the-money options are going to be somewhere here, the 118s and 120s. We're going to have in-the-money calls are here, and out-of-the-money puts are going to be over here. So you can buy calls to limit your risk. Many different ways to trade. So I was just looking at, these were, I believe these are 2-month options. These are not December. They're actually February options, I believe. So you can buy a put to limit your risk. You can buy a call. Again, these are 2-month options, not December options. So sorry about that. What if you're bullish on the U.S. dollar but want to reduce your time decay and volatility risk? How about buying one option against another? So if we go back to these, let's just believe, one scenario would be that you think that the U.S. dollar is going to rally back. And you could be buying any of these, 118, 120, 122, 124. 126 is the cheapest. But remember, it doesn't have any value until it gets above 126. You can buy the most expensive one, which means that it's pretty much going to move point for point with the U.S. dollar Canadian rate, but you're also paying the most money. It's going to be the reverse here, and for the puts. So if you think the dollar is going to sell off, maybe you'd be buying the 126, or if you wanted a little more leverage, 120, 114, and all the way down to 112. There are even lower strike price available. One of my favorite strategies are spreads. I can actually buy a call spread. If I thought the dollar was going to rally, I could buy the 112, sell the 116, and pay 290. So what's my risk? 290. How much could I make? The difference between $4 and 290, or 1.10. So that's really what I could earn. So if I didn't like that 290 versus $1.10, maybe I buy the 160, 120, excuse me, and I'd be trying to make, that one would be basically, I'm sitting being in a position that I would be able to make $1.75. And if I wanted even more leverage, I could try to buy the 120, 124 with an opportunity to make $2.32. So more leverage, but I would need the dollar to go, U.S. dollar to go even up higher. So I could do the reverse and buy put options. So I could buy in the money puts, so at the money puts, or even out of the money puts. If I thought the dollar was going to collapse against the Canadian, I may want to buy the 116, 112. And if I was right and it got to, let's say, 112, well, how much would I make? I'd make $2.95. The difference between $4 and $1.05. So that's a nice risk reward there. And one of the major benefits of trading spreads is that you're limiting your volatility risk. Now, you're also limiting your upside, but with the volatility being so crazy as it's been, many investors actually choose to trade spreads to limit the volatility risk. So just taking a look at this chart again, obviously the dollar has been in an uptrend. How long is it going to continue, or will it actually sell off? That's up to you. Really, there are a lot of ways to trade. Not only can you trade with a directional bias, you could trade with a volatility bias. Maybe you think the market's going to be more volatile in the future. If that's the case, maybe you'd want to be trading strangles or straddles if you thought that the market was going to break down much lower or break up much higher. So there's a lot of different ways to trade these. So here.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.